Welcome back. In season 1 of this series, which were the other set of videos that you can find, and in the description of one of those videos it lays out all of the different sequencing. In that series, we built a complete personal finance system. We looked at a chart of accounts, we looked at the journal, we looked at the general ledger, we looked at adjusting entries and trial balances, and a full financial statement, which included the personal financial statement or the personal income statement and the net worth statement. At that point, the system was complete, but if you were following closely, there's a good chance something didn't sit quite right. You may have looked at certain transactions, especially in that last video, and thought, that doesn't fully reflect what actually happened. This expense doesn't feel like it belongs entirely in this month, and specifically I'm talking about either utilities or subscriptions. Also, this payment seems to be doing more than one thing, and if you caught that, you'd be right. Because in that first season, we were recording transactions, but we weren't fully analyzing the timing. Season 2 is about fixing that. We are now going to get precise. Not just recording transactions, but analyzing what those transactions actually represent. This season will focus on 3 areas. First, accrued expenses. Sometimes you hear these referred to as postpaid expenses. These are expenses where the value is consumed first and the payment happens later. Examples of these include things like utilities, interest on loans, and your cell phone bill, assuming that it's a postpaid cell phone bill, meaning you've used the cell phone, you've gotten the bill, and then you're expected to make a payment. And here's the key. We will break these into exact components, including what belongs to prior periods, what belongs to the current period, and what is still unpaid. Second, prepaid expenses. These are the opposite. You pay first and you consume the value over time. Some examples include all of the subscriptions that you have. Okay, so this is where, if you looked very carefully on that last video of the first season, we had a number of different subscriptions that felt familiar because they would likely show up in your own credit card or bank account statement. But the treatment of them wasn't quite precise, and we're going to really tighten that up here. Insurance is another very common prepaid expense that people have if they pay for more than the current month in advance. And memberships. Whether that be gym memberships or spin class memberships or whatever the case is. And again, we will break these into what has been used, what remains as an asset, and what belongs in each reporting period. Thirdly, we're going to deal with reconciliation. And this is where reality shows up. In the real world, you estimate first, and then you receive the actual numbers. So for example, if we're dealing with utilities, your utility bill may cover up to, say, the 26th of the month, and you're forced to make an estimate of, well, what is the assumed amount on the 27th, 28th, 29th, 30th, and 31st, if there's 31 days in the month. So you have to produce an estimate to be able to essentially guess, an informed guess, how much that's going to be. But then you actually receive the numbers when you get your statement the following month that covers those particular days. So we'll cover credit card reconciliation. We'll cover loan reconciliation. We'll cover utility bill reconciliation. And this is where your estimates meet reality. Because once you move beyond cash, timing differences become everything. If you ignore timing, expenses are in the wrong period, income is in the wrong period, and net worth becomes misleading. But when you get timing right, your financial statements start reflecting economic reality. So here's the core concept. Here's two timelines. Every transaction exists on two timelines. Timeline 1 represents economic value timeline. This is when value is either earned, used, or consumed. Some examples include electricity is used daily. Interest accumulates daily. Subscriptions deliver value over time. This is a continuous process. Timeline number 2 is the settlement timeline. This is when cash moves. So examples would include paying a bill, receiving income, making a loan payment. These are discrete. Now let's connect this back to what you experienced. At the end of season 1, you may have recorded entries like debiting a particular expense, let's say a subscription expense, and crediting either cash or credit card payable. And technically, that works in a cash system, but under accrual thinking, that's often incomplete, because that single payment might actually represent past consumption, current period consumption, future consumption, and sometimes even a balance sheet change like debt reduction. Month end is where we fix this. It's the moment we stop and ask, what actually happened up to this point? And we introduce precision, accrued expenses, these are what we owe, and prepaids, what we've already paid for but haven't used. The system you built, the journal, the general ledger, the financial statements from season 1 is already complete, but now we upgrade the inputs because the system handles the mechanics and you handle the inputs. So here's what's next. In the next videos, we're going to go deep into accrued expenses. We've already looked at utilities in another video, but we'll address a couple of other accrued expenses in that video. We'll look at interest and loan mechanics, prepaid subscriptions, and the reconciliation processes. And we're going to break each transaction down into exactly what it represents and exactly where it belongs. So in closing, if season 1 was about building the system, and it was, then season 2 is about making that system accurate. Because once you understand timing, you're no longer guessing, you're modeling reality.